All right, let's jump right into this explainer about a silent sovereign in the American economy. When we think of global ubiquity, we usually pictured the smartphones in our pockets or those massive, sprawling logistics companies. But right now, there is an invisible Leviathan out there moving over $12 trillion in US mortgage debt. And the craziest part? It does all of this without a single retail storefront or warehouse. We're talking, of course, about the Fair Isaac Corporation, universally known as FICO. Every single year, FICO sells over 10 billion credit scores to financial institutions. 10 billion. Yeah, that's with a B. It's a number so outrageously large it almost loses its meaning, but it is literally the absolute bedrock of the modern financial system. Anytime credit is extended, evaluated, or securitized, that number is being quietly queried in the background. To put that staggering scale into perspective, 10 billion scores a year breaks down to about 27 million scores purchased every single day. Let's really contextualize that. That volume is 40 times the number of iPhones Apple ships globally in an entire year. It's actually nearly double the total number of passengers who board a commercial flight globally. FICO's product is moving at a velocity that completely dwarfs the physical goods and services we usually associate with megacorporations. Section 1. The Silent Sovereign. The de facto passport. Now, this completely faceless company actually started back in 1956 with just $400 in a California studio apartment. It was founded by two guys with a radical dream, an engineer named Bill Fair and a mathematician named Earl Isaac. Fast forward to today, and that ubiquitous blue logo represents a profound shift for all of us. If you want a mortgage, an auto loan, or even just to rent a decent apartment, you aren't evaluated as a person with a story anymore. You're a three-digit number owned by FICO. That single metric dictates your financial reality. It's the ultimate gatekeeper to your economic mobility. Section 2. Rewiring the financial system. Math over vibes. Okay, so before 1989, lending was essentially a wildly subjective process. It was purely handshake and vibes lending. You'd sit across from a local bank manager, and if they liked your story or maybe they knew your family, you got the loan. If they didn't, rejected. It was a completely binary outcome with zero nuance. FICO came in and replaced all that bias with an objective 300 to 850 mathematical scale. Why not start at zero? Well, zero implies absolute certainty of default, which is a mathematical nightmare for lenders. Instead, the model relies on log odds, meaning small point increases represent a literal doubling of your creditworthiness. It brought risk-based pricing to the masses. Over the decades, FICO systematically built an undisputed monopoly. After their founding in '56, the Equal Credit Opportunity Act of 1974 made biased lending illegal, which basically perfectly teed up FICO's objective algorithm. They launched the standard FICO score in 1989. But the true watershed moment, that came in 1995 when government-sponsored entities Fannie Mae and Freddie Mac made FICO absolutely mandatory for evaluating conforming mortgages. Literally overnight, it became the legally required language of American debt. So how does the math actually work? Well, this algorithm essentially turned personal behavior into a quantifiable asset class. It heavily rewards consistent payment history and low total debt levels. In fact, those two things make up 65% of the model's weight. It's your track record. On the flip side, applying for a flurry of new accounts triggers an immediate red flag because the algorithm actively punishes what it views as a desperate thirst for liquidity. Keep things steady, and the math rewards you. Section 3, the ultimate Tollbridge business, unchecked power. Imagine your internet provider or your utility company just deciding to jack up your rates by 8 times without any consequences whatsoever. There would be congressional hearings by sunset, right? Well, between 2022 and 2025, FICO raised its wholesale mortgage score price from about 60 cents to $4.95. That is a massive 800% increase in just 3 years. And you know what happened? Absolutely nothing. Lenders simply paid the toll. Because FICO is the universal language of the mortgage market, they had literally no choice. Because of this, their core scores segment is hitting absurd 88% operating margins. I mean, since their core algorithms require minimal ongoing investment to scale, they benefit from what the industry calls the 95% rule. Basically, for every new dollar of revenue FICO generates through these massive price hikes, nearly 95 cents drops straight to the bottom line. It's an absolute capital-light compounding machine. Legendary investor Bill Miller has this famous rapid-fire pitching style, and honestly, he would love this setup. Here's the quick pitch. Bam, it's the indispensable industry standard. Bam, unmatched pricing power with 800% hikes. Bam, an elite monopoly with 88% margins. Bam, 30% strategic SaaS platform growth as they migrate to the cloud. And bam, aggressive capital return to shareholders, including a 30% share count reduction over the past decade. It's a fortress.
Section 4, Threats to the Throne, Regulators and Rivals.
But look, no monopoly goes unchallenged forever, and recently, FICO found itself directly in the high beams of federal regulators. For a while, the biggest bear case against FICO was a regulatory push favoring a competitor, VantageScore 4.0. The threat was a structural transition from a tri-merge system, where lenders have to pull scores from all three credit bureaus, to a bi-merge system, pulling only two. That seemingly small regulatory tweak would have effectively slashed FICO's guaranteed score volume by a full third per application. It was a massive existential threat.
However, out of nowhere, the landscape shifted dramatically in July 2025 with what the industry is now calling the Pulte pivot. Federal Housing Finance Agency Director Bill Pulte unexpectedly announced they would maintain the tri-merge requirement. Boom, that effectively slammed the door on the bi-merge transition, preserving the existing market plumbing and cementing FICO's dominance exactly when Wall Street thought the engine was about to be dismantled.
Still, they aren't totally out of the woods. FICO is currently actively defending itself in an antitrust lawsuit regarding the transmission fees they charge credit bureaus. Also, while their core scores business is obviously booming, their newer cloud software segment is definitely experiencing some growing pains. It registered a pretty meager 2% growth in Q1 of 2026. So there are absolutely some cracks we need to keep monitoring. Section 5. A generational buying opportunity. Evaluating the drop. Spooked by skyrocketing inflation expectations, widespread global macro anxiety, and a market growing hyper-cautious around credit risk, FICO is currently going through its largest stock drawdown since the 2008 Great Financial Crisis. The stock has plummeted over 50% from its peak. Sentiment out there has turned decidedly aggressively cold. And the contrast here is just staggering. Up until 2023, under CEO William Lansing, FICO's stock had grown an incredible 16-fold. It was an unstoppable rocket ship. But this recent, violent 50% pullback has dragged its valuation way below its 5-year mean. So, I want to leave you with this final thought to really ponder. When you look at this incredible, inescapable Tollbridge business with its 88% margins and insane pricing power, how do you view the current dip? Is this dramatic 50% drop a trap, warning us of a broader, systemic market credit event just over the horizon? Or is this a rare generational buying opportunity to own one of the most powerful financial monopolies on the planet? Thank you so much for joining me on this explainer, and remember, keep questioning the data.